Okay, how you guys doing? Hello TradingView, hello YouTube, hello everybody. Um, this is one of my few videos that I've done on TradingView, and I'm kind of testing it out. So bear with me if I make some mistakes. So, real macro, what is it about? Well, it's about looking at the real world macroeconomics and then pointing to it and then saying, okay, look what's really going on versus what you are told is going on, or versus cherry picking data and coming up with some crazy conclusion. Now, obviously, I cannot show you the way I look at the world. That's something that you have to follow me on YouTube for. And it will take a number of videos for you guys to understand the way I view the world of economics and investing. Okay, so um, I'm going to try to keep it as simple as possible without confusing you with what I do. Now, when you look at the dollar and then you look at gold, often you're going to hear, well, the gold is rising because the dollar is falling. Okay, fair enough. Now, here's my question to you. Why does the dollar fall? There's a reason. There are many reasons. It's not just one. And this is difficult for people to understand. Okay. So I'm going to try to explain it in very simple terms uh, so you understand the differences. Number one, is the dollar falling or rising because the economy is doing better or worse? That's one. Two, is the dollar falling or rising or falling because of money printing? That's two. Is the dollar rising or falling because of fear? It's a safe haven. That's three. You can put them in any order you want, doesn't matter, but right? So there's more than one reason. So often you'll hear, well, the dollar's falling, gold's going up. Yeah, but why is gold going up? Is it going up because of fear? Is it going up because of money printing? Is it going up because or down because of the dollar? So why is the dollar going up and down? See, it's not as simple as people make it out to be. They oversimplify either because they want to market it better, they want to push a political ideology, they want to push a certain economic view. If you're a libertarian, if you're an Austrian, if you're an MMT, or uh, so I hope in this video I can explain to you the differences and how to view what is really going on. So we're going to go back and we're going to look at February 20th. And we're going to see that the dollar at the time was rising and then started to fall and started to crater. All right. What happened to the stock market shortly thereafter? Oh, I'm sorry, gold. Well, let me bring up the stock market real quick. I'll bring up, oh, wrong one. See, I got to get used to this. So it started to tank. Let me bring this line over. All right. So the dollar started to tank along with the markets. Why? There was something economically wrong. That we all know what it is now, right? But there was something economically wrong. So everybody started selling the dollar. The US was in trouble with COVID. At some point here, which was on I'm sorry, so February 28th, it started to fall. I'm all screwed up. Um, on March 9th, the dollar bottomed. Stock market kept falling. Why? What happened here? Simple. You got fear in the market. The market was falling so rapidly that people started buying the dollar because of fear. So you saw a very nice big move up in the dollar. Big move up. And then as soon as it bottomed here on, what is that, March 20th, 23rd, I see a 20 at the end, and I keep saying 20. Everything is 20. Anyway, when it bottomed in the stock market, guess what? The dollar topped out. Why? Fear was done. And then you started to see the stock market start to rise, and you start seeing the dollar start to fall. Money's flowing out of the dollar, safe haven, into stocks. Okay? Now we can debate why the dollar went up and so forth. Okay? That was also coupled with what? Printing of money. QE. Remember, QE is an asset swap. It's not a deficit increase. It's an asset swap. It converts bonds to dollars. Okay, so there's a reduction in the amount of bonds available with an increase of the money supply. Yes, it's an asset swap, but there is a fundamental difference in how many dollars exist. And those dollars don't, you can't buy a stock with a bond. You can't buy a stock with a dollar. Okay, so you had two reasons for the dollar to go down. And it kept on going down. And now we are in a situation where the dollar is starting to creep back up. And you're seeing the NASDAQ is starting to look like it's going to fall apart. You have an M pattern, as I call it, right? You have an M pattern, a lower high that's about to break. Now, if you've seen my recent post, I don't know if this can, show here or not. Again, I'm kind of trying to get used to this. I hope this shows. All right. I posted that this is going to be an M pattern, which is topping. So far, it's going my way. All right. Now, remember, I don't post every single day. My thing is more macro. My thing is it's not going to be like, oh, look, it moved 2%, and that's not what I do. Okay. So we are starting to complete that M pattern. We are starting to see the dollar pop. Is it because the economy is doing so much better? No. Well, GDP number came up 33%. Yeah, but you needed 45% to go back to January 2020. That's not good enough. Okay. Well, it's going to be better from here on in. No, you can't. You can't make that argument because when you look at the corporate profits, they're not there. When you look at the unemployment numbers, they're horrendous. Yeah, but they're better. Yes, but you can't use this excuse from 6 million down to 750,000. 750,000 is above anything we've seen since the Great Depression. It's not even, for the weekly unemployment is what I'm talking about. Okay. It's not, you're not factoring in the pandemic unemployment insurance or whatever. They're getting money, government money. There's a lot of fundamentally wrong things in the economy. So the result of what's happening is the market is going down. It's almost down 10%. And now the dollar is starting to rise. So the most likely reason that it's rising first is fear. VIX is at 40. Two, there's no more money printing. That contributes. Sure. Up. Okay. Can we say the economy is doing better? Hardly. Hardly. Okay. So what do you think is going to happen to the NASDAQ? You think it's going to hold up? Because what we're seeing now is that money is flowing out of stocks into the dollar. Let me show you another one now. 1 second. What happened? Come over here. Come on. I lost my. Come on. Don't be like that. See, I got to work out the kinks. All right. Let's do it this way. Uh, all right. Let's make this into a year. Well, we can't do a year. Let's do 6 months. All right. Bear with me, guys. This was already done and ready, and now it's not working. Anyway, so when you look at now, unfortunately, I can't remove those bars, right? When it went negative, $37, whatever it went to. So now what you're seeing is the dollar is starting to pop out and oil's coming down, right? What is the demand for oil with so many cases all over the world, so many economies all over the world locking down? Is it going to be more or is it going to be less? Clearly, right, it's going to be less demand for oil. So is it because the economy of the U.S. is doing so good and the dollar is so strong that oil is going down? No, right? Lack of demand. Lack of demand. Right. So let's go back to gold again. All right. So we're seeing that both gold and the dollar have been falling. Oh, come on. This is a better way to look at it. Okay. And when did the dollar peak out? I'm sorry, gold peak out? August 7th. Okay. There was still that hype of that second stimulus. Yes, we're going to negotiate and we're going to do this, we're going to do that, and whatever. And then as the stimulus started to go away, well, gold started to fade away and the dollar was kind of fading away. And then the dollar's kind of bottomed there, but gold kept falling. It wasn't falling because the dollar was rising, right? So some of that froth came out. Now, clearly, you can see here in June how uh, dollar was falling and the gold was rising. Why? Because deficits were so extreme at that time that, of course, gold is going to go down and dollar is going to go down. I'm sorry, gold's going to go up and dollar's going to go down, right? That's monetary inflation. So again, you know, try to understand the macro aspect of investing. Mix the two together. Don't be running around saying, well, the dollar is going down, gold's going up, blah, 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 and just this oversimplified view. Try to understand which of the three is true. And the way you do that is you have to read the message of the market. What is the message of the market? It's to look at all the indices worldwide. It's to look at the dollar. It's to look at emerging market currency. It's to look at the IS, special drawing rights, SDRs. Special drawing rights are um, the IMF version of world reserve currency. Okay, uh, take a look at what is happening uh, in terms of COVID, in terms of cases. All of that comes together. All of it. Okay, it's vitally important that you understand it and you keep up with it. Now, macro typically is not something that's going to change day to day. Typically, okay. With COVID, it does change more so day to day because a central bank is going to come out and they're going to tell you, well, today we're going to print this and we're going to have this lending facility and that lending facility and the other lending facility. And it's not necessarily just the US. Okay. You got the ECB, you got China, you got India, you got all these other economies doing the same thing. And they keep pumping money into the world economy. So in that sense, macro does change. Um, in terms of cases, this is the third wave that we're going into now. Okay, remember that we locked down when there was so far fewer cases, and we managed to, in some cases, really bring down the death rate. Italy, Spain, New York, right? It worked, but it's not a vaccine. It's not like, okay, we're going to lock down once and then we're going to go back and da 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 da, off we go. It doesn't work like that. Okay, it's not a hurricane. It's not an earthquake that hit and now we're going to rebuild. It's not a hurricane that came by, destroyed everything. Now we're going to fix it. That's not what a pandemic is all about. Okay, so in that sense, macro does change a little bit more, a little faster. Now, when you look at the stock market and you contrast that with the macroeconomics, you end up in a situation where you are misled by price. Price in a stock market is an advertising mechanism. It's just advertisement. If you pump $4 trillion into the economy, that money is going to flow to the top 5% and it's going to flow into profit savings. That profit savings ends up in the asset classes like stocks, bonds. Okay? That's going to affect the dollar. That's going to affect the stock market. But when you price the stock market in dollar terms, you are not rising in the same manner. If you look at the Venezuelan stock market and you look at the currency, you're going to see that the stock market actually went up in a hyperinflation situation. It literally went up. Why? Because revenues and profits are going to rise nominally. But if you factor in the currency devaluation, you lost your ass. So what? You went up 1,700% in a year in the stock market. The currency devaluation made that move up worthless. You're down. You're losing. So keep these things in mind. The economy is not doing well. Nothing has changed since March. You're going to hear, oh, the lockdowns are the problem. Oh, opening up is going to save the world. Oh, no. Do not misunderstand price of the stock market with the economy. It's a mistake. It's a big mistake. We are still in a pandemic. We are still in a very bad economy. We're in a depression. I call it a depression. You may disagree, that's fine, but we are in a depression because we're not going to even come close to where we were January 2020. Okay, not even close. The US has two main problems. One, we are very highly leveraged. Okay, a lot of debt, and I'm talking about private debt. And we are a consumer-driven economy. If we're not at the mall every single day, there's something wrong. To us, it's a depression. Okay, if you're in India, you don't have that problem. Right? If you're in Bangladesh, you're not worrying about going to the mall every day. So, what has to happen? What happens when consumption drops? When consumption drops, somebody else has to consume, right? Why do savings go up in a recession? Because people are fearful if they're going to have a job. Those that do have a job, they're scared. Okay. MMT will tell you no, it's because of deficits and it's pumping everybody full of savings. That is a mistake. That is wrong. That's not the reason why. When you have a job and everybody else is losing their job, you're going to consume less and you're going to prepare for the worst. If you're normal. If you're not, then whatever. But most rational people, that's what they do. So when you are increasing your savings, then somebody else has to make up for that consumption, right? Well, how are you going to do that? Well, we're going to print money. We're going to give it to helicopter demand side. Okay. How did that work? Not very good. Not very good. Well, GDP grew. No, GDP had to be 45% on a month or a quarter over quarter basis to come back to January 2020, not 33, 35, whatever it was. This is fundamental, right? Don't cherry pick data. The benchmark is January 2020. Okay, not the bottom when we started to open up in April. And all of this information you have to put together. It's a mosaic of data. No one piece is more important than the other. Okay, but it all starts with the dollar. It all starts with understanding what the three main drivers are of the dollar. Okay, money printing, how good the economy is or isn't. Okay, and fear. We're the world reserve currency. And there's three different reasons why it can move. You have to figure out which one of those three comes first, second, and third. Okay. Um, Again, I'm going to say that the U.S. is in trouble right now, as I showed you in the picture here. Right. Look at corporate profits, and this is lagging big time, unfortunately. Historically, corporate profits are way down, and initially you're going to see corporate profits do a lot better than normal. Why? Because you can cut costs a lot faster than uh, uh, than revenue. So you're going to see an artificial bump, especially when you go into a lockdown and then you have that pent up demand. And then that demand shows up, and the next quarter you're going to see, oh yeah, everything is great, yeah, but as savings start to drain, as stimulus starts to go away, reality and you don't get that bump from cutting costs really quickly, then reality starts to hit. So don't be misled. The economy is still bad. The markets will eventually reflect reality. Okay. And it all starts with the dollar. And start from there and then go through all the indexes. Okay. Top to bottom. Go through the currencies, top to bottom. Start with the monthly, weekly, daily. Okay. You can go as small as you want. Okay. And understand what the message of the market is. So that's it for this video. Thank you. I will probably do more of these videos. I will also do some live, as I do on my YouTube channel. I do live. I'll start Monday. Usually I do them into the close if there's nothing going on. Sometimes I do them before that. Like and subscribe, and you can see how we look at the market completely different. All right. Take care. Thank you, and I'll talk to you soon. Bye bye.